Hello and welcome. At the beginning of the year, it seemed that the Indian economy was cruising along. Initial estimates suggested that India would grow at over 7% this year. But the July-September quarter growth numbers stunned everyone as GDP growth slumped to a 7-quarter low of 5.4%. The biggest question at this moment as we dive into 2025 is whether the slump in growth is temporary. Is the fall restricted to 1 quarter of flailing growth, or is the slowdown more structural and long-lasting? To talk about the India economic outlook for 2025, I'm joined on this special discussion by 3 sharp economic minds. I want to introduce Neelkant Mishra, the Chief Economist at Axis Bank and the Chairperson of the Unique Identification Authority of India, better known as Aadhaar. I have Dr. Rathin Roy, former Director of National Institute of Public Finance and Policy and a Distinguished Professor at the Kautilya School of Public Policy. And we have Dr. Soumyakanti Ghosh, member of the 16th Finance Commission and Group Chief Economic Advisor at the State Bank of India. Neelkant Mishra, I'll start with you. The biggest question really, I think television and everybody else should be talking about this one question much more than anything else, is whether that Q2 dip in growth to 5.4% that we saw, is it a 1-quarter slump in growth numbers, or do you see this as being indicative of a longer lasting slowdown in India's growth trajectory?
Well, I think there is one-off nature to this. The economy saw unintended, and I'll clarify what I mean by unintended sharp fiscal and monetary consolidation in the first half of the fiscal year, and that really drove the growth slowdown to be that sharp. I mean, there are some more longer-term challenges, and we can discuss that later. On the fiscal side, in the first half of the fiscal year, the central government incurred about 29% of its usual fiscal deficit. So if there is a 100 rupee target for the full year, generally the government incurs about 62 rupees. This time it incurred 29 rupees. So there was a 33% slippage on the full year fiscal target, which means 1.6 percentage points of GDP of unintended consolidation for various reasons. So this was a very fast pace. So if you just annualize that, that's like 3% of GDP. That has started to normalize. So it is reasonable to expect that as we enter FY26, the tailwinds of a late year splurge will be supporting us. On the monetary side, while I think the RBI has very limited room to cut rates, I think there has been a slip up on the quantitative side. The quantity of money available. If you remember, there was a lot of debate on the deposits there not being there in the system. Deposits in the system are a macro variable controlled by the central bank. And that was a major reason for the shortfall. Around the beginning of the fiscal year, the central bank became overly focused on the credit deposit ratios. Banks were asked to bring down that ratio. As the banks slowed down credit, it actually accelerated a downward spiral. And credit growth has declined from 17% to less than 11%. If you see that pace of monetary of financial tightening, obviously the credit GDP growth will slow down. With the CRR cut and hopefully with some more backing off from the regulator, if the credit growth revises from here, I think it's reasonable to expect that FY26 could be upwards of 6.5%, maybe even 7% growth.
So let me put that same question to Dr. Rathin Roy, and I want to show you these estimates put out by different agencies and research houses, all of which have corrected what they think will be India's growth number for this fiscal year. Initially, the forecasts were far more buoyant than currently. Each of those, and you've got them on your screen right now, pulling back by about 0.5 percentage point roughly over what they were expecting earlier. Rathin Roy, Neelkant Mishra makes the point that in the second half of this fiscal H2, that there will be greater government spend and there will be a catch-up effect. And while there was a slump in growth in the second quarter of this fiscal, we will soon be bouncing back. Is that your assessment as well? And what's your economic outlook for next year?
Well, first let me say that I don't do astrology, unlike any of these forecasters there. And they have the luxury, unlike most astrologers, of revising their astrology. I haven't seen any credible modeling backing these so-called forecasts. These are basically very crude exercises. And they're meant for an audience, a Bombay market audience. So it's okay. But I don't think we should take them too seriously. And in that sweeping statement I've made, I'll include the IMF and the World Bank for other different reasons. So it's not just our chaps. Now, in terms of growth, I agree with Neelkant. I agree with Neelkant that we will perform moderately well as we have moderately well in the past. I'm not sure we'll get to 7, but unless you do something to deeply damage the economy, like demonetization, 6 to 6.5% growth typically would be what you would expect, as an average over a 3 to 4 to 5 year period. That is the fact that is not enough and its quality is very poor, either from an employment perspective or from a well-being perspective or from a prosperity perspective, is a structural matter. But I think Neelkant is right for the reasons he adduced. But just to give you one example, I mean, if the growth rate of a market economy is so dependent on fluctuations in government spending, then something is clearly wrong with the economy in terms of its structure. So with those caveats, I would say that the proximate causes that Neelkant gives are quite correct. I'm not quite sure about the credit growth story there. I mean, possibly that is also happening on the demand, purely because of lack of demand in the right places. The other factor I would add is the extent to which, given world trends, nothing to do with India, well, nothing majorly to do with India, foreign investors behave with respect to increasing or maintaining their investments in the Indian economy, both in terms of FDI and in terms of FII. Outlook-wise, therefore, I would say that we will continue on the path of amiable but stable mediocrity that the economy has been on for the last 3 or 4 years. And I see nothing in the bargain to change that. That does have terrible implications in terms of jobs, for example, good jobs. It has terrible implications in terms of the ability to invest in health and education, both on the public sector side and the private sector side. It has terrible implications in terms of India matching up to being the 3rd largest economy in the world, in terms of also seeing a quantum increase in prosperity of the bulk of its population. But on the macro side, I agree with Neelkant. I think we will hit comfortably unless somebody screws up again, and there's plenty of room for that. You've seen that on track record. Unless someone screws up again, 6.5 is what you'd actually...
You're calling it amiable but stable mediocrity. Saumyakanti Ghosh, first let's just focus on what's left of this year and try and get your sense at SBI about what you estimate will happen and how much do you think the bounce back will be, what explains the slump, and secondly, your economic outlook for the next fiscal.
Yeah, thank you, Rahul. I think, Rahul, just before I start, I'll just put to it an interesting data. In the last 33 years since Indian economy liberalized from 1991 to 2024, if you look at the average growth rate, that has been at 6.1%. And interestingly, in the last decade and this decade, if we exclude the years of the global financial crisis and the years of the COVID, the two growth rates have been at 7.2% for the last decade and 7.3% for the decade ending 2024. So the aspiration of India actually has moved higher from a 6% to 6.5% growth rate to 7% growth rate. So therefore, the 5.4% growth rate in the second quarter was a disappointment. But I would like to add to the point that there has been some factors concerned. Some of the points Neelkant mentioned. I just want to add another point which is extremely important from an economic perspective. I think there has been we have seen a significant slowdown in the capital expenditure on the part of the states. Actually, the states have been undertaking a lot of revenue expenditure, but there is also an support which the central government gives in terms of an interest-free capital expenditure. I think this year the budget was presented in July, and the contours of that package was worked out in the month of August. So if you look into the first quarter data of almost all states, including the larger states, there has been a significant and sharp slowdown in capital expenditure. So that is also hurting the economy. The second point to note is that I think there has been significant geopolitical uncertainty. The manufacturing sector, which has actually slowed down the most in the second quarter, I think a growth rate of 4%, has been hit by also declining margins. I think that's a statistical artifact, which I don't want to get into it. But I think much of that will correct possibly in the second half. It is debatable how much it will correct so that we can have a growth rate in excess of 6.5%. But a growth rate in excess of 6% looks reasonable at this point of time for this fiscal.
Okay. I want to build on something Ratin Roy said and put that to Neelkant Mishra, that if 1.6% of the economy's growth rate gets chopped off because of inadequate government spending, Ratin Roy makes the point that that reveals something structurally wrong with the way the Indian economy is growing. He also questions the quality of jobs being created and the quality of growth. So let's spend a moment on that, Neelkant Mishra, because the fact that we've been talking about a capacity expansion cycle kicking in for a long time. I was reading your economic outlook. You seem to suggest that in some sectors it's already started. You want to build on that and explain to our viewers why you think that this wait for an expansion cycle to begin could finally be over in your view?
Yeah, so see, the first half of the year, I think Ratan is absolutely right that any economy shouldn't be so dependent on the vicissitudes or the pattern of government spending. But, government spending tends to be quite stable. In the first half of the fiscal year, as I said, the 10-year median is 62% of the fiscal deficit is incurred. 29% is like a 25-year low. So it is very, very, very rare for a government to miss or be so far behind in incurring a fiscal deficit. And if you have that level of slippage, 1.6 percentage points of GDP squeezed into 6 months, I think that is like 3% annualized. And that's a remarkable pace of unintended fiscal consolidation, which the economy will see that. So I think we have to keep that in mind. On the quality of the growth, and before that, let me answer the question that you put in towards the end, which is why I think that the investment cycle is recovering. From 2012 to 2021, where the investment to GDP ratio declined from 34% to 27%, 7% points of decline. Most people think this was because private sector capex didn't happen. Private sector capex did slow down, but 5% points of that 7% points was because of a slowdown in the real estate sector. So it was household investment in dwellings, which was the major cause of the slowdown. So the real estate cycle in India peaked in 2012, it bottomed out in 2021, and since then has been reviving. And it is reviving for a very simple reason, that the inventory of built houses is low, prices are now more affordable than they were 10 years back because of steadily underperforming income growth. And now there is a cycle, and this is like absolutely natural. I was presenting this to someone senior in the government. He said, okay, this is happening naturally. What can we do to accelerate it? And so that's the way to see it. The second reason why the investment cycle weakened was the power generation cycle. If you recall, there was a phase where India with 130 gigawatts of power capacity was adding 200 gigawatts of power capacity. This was in 2011-12. We didn't have the coal, we didn't have the linkages, and these power plants were being built. Obviously, the story went bad very quickly. Now, between 2016 and 23, there's been barely any capacity addition. And therefore, the industry and the economy needs more power generation capacity. If you add both of these, there is a reasonable case to be built that the investment to GDP ratio, which has rebounded to 31, would actually become 34% in the 2027-28 type of time frame. So this is the reason why I think that the investment cycle is starting to revive. There are many new areas like robotic, green hydrogen, like renewable energy, like defense production, data centers, which all of them require a significant amount of capex. On the quality of jobs being created, remember that at this stage of the cycle, and I think Ratan would know that way better than me, given how deeply and how many economies he has studied. At this stage of economic development, labor is in surplus, capital is in shortage, labor's pricing power declines, and therefore the inequality tends to widen. And therefore, at this stage of development, the fact that lower income consumption is not doing well or not doing as well as the rest of the economy is something that should be anticipated. It is a political problem, it's an economic problem that needs to be addressed, but it does not, in a way, signal that the economic growth is not happening.
Okay, let Ratin Roy now respond. And let me frame the question thus, that one, there's been a lot of criticism of the government's reduction of corporate tax rates, saying, while balance sheets have become greener, a lot of it is money going into the pockets of industrialists. It hasn't been pumped back into the economy in the form of new capacity expansion. Neelkant Mishra makes the argument that that is now finally turning, and he's highlighted several sectors where he sees the investment to GDP ratio going up. A, do you buy the fact that now, because capacity utilization is where it is and that a new cycle seems to be starting, this could change over time some of the structural concerns you raised in your first intervention?
I don't think it's going to change this year. I think Neelkant's points are very logical. But let me give you an interesting facet. I now live in South India. And in South India, the real estate inventory is at its largest in the last 5 years. South India is where all the action happens. UP and Bihar, nothing happens there. I mean, I'm not saying, the majority of the population lives there. It's a big worry. But there's no action there. These are dead weights. And southern and western India is where the growth takes place. The per capita income of UP or Bihar is less than Nepal, for God's sake. So, and that's a big structural multi-year problem we have, that the majority of our population lives in areas which have per capita incomes that are LDC levels. And in the other areas, we see growth struggling, chiefly because in these other areas, one of the major impellers of growth has been manufacturing. So if what Neelkant says happens and happens at a scale wide enough to outweigh what I'm seeing in the peninsula, and real estate demand picks up, construction demand picks up, new areas pick up in adequate measure, then I would be looking at the share of manufacturing in GDP to be moving north again, and the share of employment in agriculture to be reducing again, before I'd be satisfied that the structural problems that the economy faces are being altered. When it comes to the corporate tax rate, well, I don't want to say I told you so. I did tell you so. Enough said.
Okay. Soumyakanti Ghosh, let's spend a moment talking about whether adequate investment is now beginning to take place in the India growth story. In that economic outlook that Neelkant has put out, he makes the argument that a new, fresh expansion of capacity cycle has begun. Do you buy this? Are you seeing enough data around you to suggest the same?
Yeah, I think, Rahul, if you look at the investment data as a percentage of GDP, I think, yes, there has been a steady recovery since pandemic. And the FY24 data will be available only in February 2025, but reasonable to assume that it could cross around 33% of GDP as per the current trends. If you want to break down and ask for the investments, whether the investments are happening, yes, they're happening. If you actually look into one of the proxy for these investment requirements is the gross block data of the corporates. If you look into the last 4 years data, the total number is actually at 8 trillion. So it's happening, but the issue is that it's actually happening in new sectors which takes times to multiply. For example, it's happening in sectors like renewables, it is happening in sectors like solar, it is happening in sectors like healthcare. Education is also one of the sectors. So all these sectors are new age areas, and fintech is another area. So all these areas are new areas, and here it takes time for the investment to fructify. So that is possibly the reason that why you may not have seen an investment boom. As Rothin Roy mentioned, the share of manufacturing to GDP is currently around 17 to 18%. The hope is that it crosses 20%, because at the end of the day, the manufacturing sector will be the cornerstone of the more job creation. But in my sense, I think there is a pipeline of investment proposals, which we even see in our bank, which has not materialized. And hopefully, once this geopolitical uncertainty clears off a little bit, and there is some certainty on the external front, a large part of this investment will start materialize.
Okay, you've spoken about uncertainty on the external front, so I want to dive straight into it, because the big change happening in January itself is the 47th president of the United States, Donald Trump, takes over for a second term. He's promised to increase tariffs against neighbors, against countries like China, also indicated about increasing tariffs at what he called the tariff king, India. What potential short-term impact, Neelkant Mishra, do you think India needs to look out for once Trump takes over, and what impact could that have on our growth prospects for next year?
I think the most obvious impact is going to be that the cost of capital globally goes up. See, there are several fronts on which he has signaled he wants to act. That's been his mandate. The first is immigration, and we're already seeing that there is a lot of debate within the Republican establishment on what they mean by controlling immigration. Is it legal? Is it illegal? Is it H-1Bs? Is it something bigger? The second front is, of course, trade, where he has threatened tariffs on everyone, including India on the reciprocal tariffs. If that was to happen, there's a direct $7 to $8 billion impact on our exports. But most likely, these are just starting points for a negotiation, and we'll see how it shapes up. But the third front, on which I think he has much more control and it's very likely to happen, is the extension of the 2017 tax cuts, which by itself will mean that the outlook for fiscal deficit and the debt to GDP in the US worsens. We have already seen the 10-year bond yields in the US starting to spike. And what that means is that the cost of capital for the rest of the world goes up. And Ratin mentioned early on that emerging markets, equity investors are deserting India. They're deserting all of emerging markets. In fact, the knee-jerk reaction, the Pavlovian instinct for any emerging market investor, and for right and understandable reasons, is that when you're getting 5% yield on US government bonds, then why would you want to hold China, Brazil, and India, or other such emerging market currencies, which we don't really understand. They don't really understand. So the cost of capital goes up. The amount of current account deficit that we can sustain goes down. The foreign generated, foreign capital flows as a percentage of GDP, if you plot a 5-year average, which is the averages over a cycle, it is down by 1.5% points versus, say, 10 years back. And what that means is that risk capital formation in the economy that slows down. So what we are seeing today in terms of the interventions that the RBI needs to do to keep the rupee stable, I think those interventions may need to will actually perhaps worsen from here. There will be other, I think, second and third order effects if the Chinese RMB was to devalue. So if Trump on day one, 20th of January, imposes, forget about 60%, even 20% tariffs on China, the likelihood of the RMB, the USD CNY falling to 7.8 goes up. If that goes up, then should the RBI let the rupee fall similarly or let it get there in 6 months? I think those kind of bets will then start getting made. So we should expect significant increase in the macroeconomic conditions, global conditions in terms of interest rates and currency after 20th January.
Ratin Roy, it's very difficult to predict what Trump will do, how much of the positioning that he's taken is to do with, just setting up a position for a negotiation, or how much trade tariff increase he actually intends to push through. What's your best sense at this moment of how whatever Trump does internationally in terms of tariffs for other countries, neighborhood, China, and potentially India, could impact what we see around us in our country?
Well, I agree with a lot of what Dilkar said. I think it's a very sensible global analysis or prognosis of what's going to come. On tariffs, I just want to point out a very interesting point. Why we shouldn't get our dhotis in a twist about Trump's tariffs. India is 2% of global exports. So actually, a government of India undershooting its fiscal plans in the way Nilkant mentioned is going to have a far greater shock on the Indian economy than what Trump does with tariffs for us, because they're not players. We are big players in the global economy, whatever we boast about. Now, if we want to be non-big players in the future, we're not talking about. Today, we are big players. The real impact, as Nilkant rightly says, is on the financial markets. There again, I said at the beginning that what worries me in India is that, people screw things up. What are called unforced errors, a bit like in this cricket match that just finished. You go out there and you're supposed to play a defensive game and you try and hit the ball for a 6 and you get out, you lose the game. So there is a fear, I have heard from many quarters, I don't know if it's true or not, that the RBI is now following a, if you like, Hindu nationalist policy of keeping the rupee strong because it should be strong. And that is a dangerous game to play in these circumstances when there is a great deal of volatility involved. Now, I'm not saying that I'm not one of those people who believes that the rupee should find its own level, abolish all capital controls. You can't do that in a third world country like India, where people want to take their money abroad and when the playing field is not level. But a calibrated depreciation of the rupee with clear announcements effects as to what we will do when forward guidance comes in as to what is going to happen to the US dollar, factored in perhaps with any structured announcements that come, I think more clarity on that would help both foreign investors and domestic investors understand how to cope with, I agree with Nilkant, what is going to be a very turbulent year. There is a clear, I find, lack of clarity. It's got very bad with the RBI. With the finance ministry, it was never very good. It is now absent. With the RBI, there is a clear and pleasant lack of clarity on the logic underlying its monetary policy and exchange rate actions. And the more clarity we get in, and the more forward guidance we give on how we are going to implement a policy that we publicly state, I think the more secure we will be in the next year.
Soumyakanti Ghosh, do you see in Trump's tariffs a potential opportunity for India if he does go out and impose, forget 60, but even 20% additional tariffs on China? Could it, in a slightly more medium to long term, create more potential for India to capitalize on the China plus one opportunity and emerge as a more significant manufacturing destination than it is at the moment?
Yeah, I think, Rahul, an interesting data is that during Trump's time, last time when Trump was the president, the rupee had depreciated by 11%, and during Biden's time, it has depreciated by 29%. So obviously, if you look into that from that perspective, even after taking into account all the hullabaloo about these tariffs, I think there is an opportunity. If you look into India's export basket in the last 3 to 4 years, that has significantly diversified. That has diversified across markets. There is now more south-south trade, and also it has started to happen in exports, which added more value. For example, engineering exports is one of them. The only point of concern basically of the exports which will be price elastic, for example, textiles, garments, which we need to take care of. But a careful look into the composition of the Indian baskets in the last 3 to 4 years, you will find that there has been a lot of value addition in terms of export share, and also there has been diversification of the export bucket outside countries of US and even Europe to the more south-south. So from that point of view, India has an opportunity, and I think that whatever China will do in terms of pushing down its yuan will have some impact on the rupee, but over a point of time, I think these will be short-term disturbances, but we have seen that over a point of time, if the economic condition remains strong, the rupee will bounce back from the lows, and that is going to act as an enabler in terms of the overall export push.
Let's spend some time talking about foreign investment. Nilkant Mishra, as far as foreign portfolio investment is concerned, the calendar year which ends was a rough year. We barely had any net foreign portfolio investment coming into India. As you mentioned, that's on account of how attractive US assets look at this time. Do you see that continue all through next year? I was interviewing Ruchir Sharma some time back. He said he expects that at some point in time, the American bond market is going to start pushing back against Trump's policies, and that could be the time when foreign money starts moving back into India. What's your outlook as far as how foreign investors are looking at the Indian stock market is concerned?
Yeah, and before that, let me quickly endorse what Ratan said, that while there will be a lot of global volatility, the major drivers of Indian growth are internal. So while we should pay heed to what's happening globally and try to take advantage of it, in fact, one of the things that has happened is China plus one is now back in focus. So with Trump coming back, most global firms are re-looking at their global manufacturing, and there is another opportunity for us to take advantage of trying to become an alternative to China. So, but at the same time, I think it is internal policies that will drive a large part of our growth change. On the foreign portfolio investors, see, only about 14-15% of the investment in India is through India dedicated funds. In fact, it's actually less than that, most likely. Most of it comes through either sovereign wealth funds or emerging market funds or Asia funds or BRICS funds or global funds. And they have a very different prism through which they evaluate the world. If the US 10-year yields are high, then every other asset class gets a lower weighting. On what happens during the course of the year, I think very likely that we start off the year with an increase in yields. We have seen some of that already. Maybe the markets are expecting it and pricing it in. But if the 10-year yields go up to a certain level, so in fact, what we have forecasted, what we have said is that stated policies by the US president-elect will mean an increase of about $7.8 trillion in debt over the next 10 years. Bond markets, which are the only way to discipline him because both sides of the legislature are now under Republican control, will mean it's only the bond markets which will discipline him, and therefore the increase in debt would only be about $3.5–4 trillion, which by itself would mean that 10-year bond yields remain quite high. during the course of the year, given that there is a very high interest cost burden now starting to affect the U.S. federal balances, the likelihood of financial repression or a restart of financial repression is something that I think can actually push the dollar down. So right now, the trade-weighted dollar is appreciating because of the higher interest rates. But once, say, post-June, the Japanese central bank gets some room to act. By then, the political uncertainty in Spain and in France and Germany would be over. The euro can actually start rebounding. And then I wouldn't be surprised if at the end of the year, the trade-weighted dollar is actually much weaker than where it is, say, in late January, early February. So the right way to look at the USD INR, the Indian exchange rate, the Indian currency, is to allow for a wider trading band instead of trying to keep it too stable. So it is quite likely that it ends the year closer to 86, maybe 86 and a half, and doesn't have to go to 90 if the USD CNY is not changing. But either way, I think the very low volatility of the rupee is something which is creating some risks, and I think it should be allowed to be a lot more volatile.
Ratin Roy, Soumyakanti Ghosh made the point that as Donald Trump imposes some of his new trade tariffs, it increases the prospects of additional foreign direct investment coming into India for manufacturing, that China plus one comes alive again. We largely missed the boat last time round, but on account of various factors, some external, some internal, we may be able to capitalize on the second wave much more than we were on the first. Do you buy that?
You see, I mean, I agree with Soumya that, I mean, there is always the prospect. Why not? It's a very large economy. It's the largest economy, after China on the globe. It's the largest economy with a large labor force. But I mean, this is where our structural features, do us in. The south of India now is seeing per capita incomes where you have high human development, close to 100% literacy, south and west, are now seeing, wage rates where a number of things like cheap textiles are simply uncompetitive if you actually put them in Vapi or in Tirupur. You would need to put them in UP and Bihar and Haryana. But for a variety of reasons I can't go into here, those places which have a per capita income lower than Nepal are unable to absorb this sort of investment. The kind of quantum shift in productivity that you need to see in the north and east of India for India to become a favorite investment destination, given ramshackle governance, ever seen the traffic here compared to Vietnam or someplace else, is such that countries would probably want to, I feel, spread their bets across a number of smaller geographies in the ASEAN, rather than coming to India.
So you're saying what you are, and I can see Neelkant shake his head very strongly, wanting to disagree with you. Go for it, Neelkant. Explain your disagreement.
Ratin, very close to where you are right now. There's a area which specializes in shoe assembly, and there you look at shoe assembler, the wage rates are 10,400 to 11,300 rupees a month. And when you ask the company, so 5 of the top 10 global shoe manufacturers, and all of them are global, of course, Taiwanese or other countries, from other countries, they are setting up factories in Tamil Nadu. And they are, in fact, I did a field trip, tried to meet most of them, and they're saying, there's unlimited labor supply. So even in TN, you'll be surprised the moment you move out of Chennai. You're talking about 10,500, 11,000
You can't get them to make shirts that we import from Bangladesh and Vietnam. So I'm talking about I'm not talking about foreign direct investment coming in and getting a couple of thousand bespoke laborers. That's always there. And there's high skills in Tamil Nadu.
No, we're talking about, sorry, nothing. See, in the assembly business, the lowest end assembly is shoe business. If you go to a shoe factory, you'll wonder, how is it any more advantageous than a cobbler kind of banging together a shoe? It is really low end. And that's where you are seeing one factory with 20,000 people. There is a Fengte, which is a Taiwanese company, which has set up operations about 10 years back, already has 28,000 people. It's setting up a third factory with 20,000 people. So the employment in shoes themselves, just in TN, could be well above several 100,000 if some of these plants bear fruit. Look at what has happened today. Foxconn has inaugurated this $238 million facility for housing female workers working in the electronics assembly plant. So I don't think like Tamil Nadu is priced out, and Tamil Nadu is not priced out, and there is enough labor in India. I don't think that is the challenge.
It's not priced out of making shoes for foreign investors who come in. That's not the point. It is priced out of making shirts for Indians, which we currently import from Bangladesh and Vietnam. And it is not priced out purely because wage rates are too high. That's the reason they give. But my point still remains: your Foxcons are not going to UP and Bihar. Your Foxcons are not going to Rajasthan or MP.
No, but
all you see
that's
there is stock, and that is where the majority of the population lives. And hard fact, per capita income there is less than Nepal. So that is where an increase in per capita income will see an increase in prosperity. That's why
that is global. 70% of Chinese exports come from 4 provinces.
Sure.
Yeah, sure. But 70% of China
This is absolutely standard. Coastal provinces.
No, it is not standard that the majority parts of the country, where the majority of the population lives, is 7 times poorer than the minority parts. That was never true in China, because Guangzhou and those areas were the most populous. So if this was ulta, if UP and Bihar were high productivity and doing the things that Tamil Nadu and Kerala are doing, I'd be happy. But that is not what's happening here. And what is happening here has only ever happened before in the former Yugoslavia and the former Soviet Union. You cannot have minority of the country with low political power doing all the economic heavy lifting, while the majority of the country with high political power doesn't get the opportunity to do economic heavy lifting. That's my limited point. So in terms of 6.5%, 7%, one shoe factory, 100,000 people employed, no quarrels at all, no disagreements. But in terms of really shifting the needle and doing a China +1, not until you bring North India into this. The game will not work without Northern and Eastern India coming in. That's my point.
Okay, no, see, I do not want to make the point that we don't need to do anything. I think there are some heavy structural reforms we need to do. There's some big changes we need to make. And there has to be at Delhi, and not just in Delhi, but also at state governments and local governments. There are massive structural reforms needed. Urbanization is, I think, a massive challenge. It's gone completely unnoticed. But I want to also be cognizant of the fact that even in China, you read a book called Invisible China. There is, 70% of the kids are being born or are less than 5 are in rural China, where the IQ levels on, infant IQ measurements are abysmal. There are problems with nutrition. So some of the challenges are universal challenges. It's not just unique to us. So even as we approach them, needs to be a less of a spirit of despondency and more of that, okay, you know what, we need to solve these problems. That's all I'm saying. So instead of being pessimistic, I would rather continue seeing this as an opportunity.
No, but what I find, I would love to be see it as an opportunity if something was ever done about it. But when we have reached a situation over 40 years where the per capita income of UP and Bihar is less than Nepal, forget Bangladesh, less than Nepal, and the human development indicators are worse than Nepal, I would act with a little more urgency and not be so sanguine. I think that's the only difference between what we are saying.
The interesting thing is that next year is one of those rare opportunities in the Indian election cycle when you have only 2 elections. You have Delhi at the beginning of the year and you have Bihar, in September, October. So you have policies, you have space for pushing through economic reform. So Neelkant, your sense of the commitment within government at this moment of wanting to push through some of the structural reforms you spoke about, and given that reforms are always complicated unless there's a massive crisis, which are the reforms, which are the areas that you think the government should be concentrating its political firepower on so that they can make those changes, receive the least amount of blowback, and yet make the maximum impact?
Yeah, I think there are several areas which the government can and should work on. And I think, issues of taxation, simplifying the tax structure, improving, which is a very critical part of improving compliance. We need to also, and I'll repeat here, improve the governance, the tier 3 governance. I think the fact that less than 5% of fiscal resources go directly to tier 3 governments versus say 50% plus in China, which is another extreme, or 27-28% in the US, giving some of the cities a lot more authority to govern themselves and basically cater to local needs and be more responsive to expansion. I think there needs to be a lot more of a push to making India a product nation, which is, again, these are all areas on which I'm aware that the government is aware of the need for it, and I would expect that some of these changes should start becoming visible.
Okay, Soumyakanti Ghosh, let's get into some specifics. The headroom, as we've seen, to be able to push through economic reform is very limited. Whenever the government has attempted this, faced a big pushback like there was on the farm bills or even land acquisition. Next year does provide a big opportunity. You've got a government that is now stable. There's no immediate threat to it. The allies seem to be on the same side as the BJP, and therefore there is some headroom to try and push through some reforms. Then the budget is coming up. Where do you think Nirmala Sitharaman, Prime Minister Modi should be focusing their energy?
Yes, Rahul, before that, I'll just take 30 seconds to answer a point on the last time. I think instead of looking into the North-South as a country, I think South also had an advantage of declining population in the last 30, 40 years. The North did not have that advantage. So we should have to normalize in terms of the total population also before we try to speak about this North-South issues. Now, coming to the specific points of the next budget, I think the first thing is, apart from the taxation issue, direct tax code is coming up. There needs to be reforms in the indirect tax code in terms of making it more simplified. Petroleum, for example, could be borne under the indirect taxes code over a point of time. The second point which I would like to touch upon, and I think the government had tried that in the past, is there's some very low-hanging fruits happen in the agricultural sector. I think the agricultural sector is in dire needs of a price discovery. We have been listening to this for the last decade or so, last 2 decades of price discovery. We have tried to solve that, but there are some very low-hanging fruits in the agricultural sector which could be acted upon. And the third important thing, I think 2 more important things. One is the judicial reforms. I think cases are pending in the judicial system from 1952 onwards. We need to have a holistic approach to solve it. And finally, for the SME sector, I think there are also some low-hanging fruits which the government can actually look into. One of the low-hanging fruits is basically the pending bills payment for the SME sector, which could be solved up with a little amount of effort, which basically also is a low-hanging fruit.
Okay, Ratin Roy, where would you like to see Mr. Sitharaman and Modi focus their political capital in terms of pushing through reform, given the stage of cycle of this government? You're in a second year, the general election still very far out. You've got some maneuvering space. Where should they be focusing for maximum impact?
You see, I live in the south of India now. And therefore, this idea that government is the prime mover of everything, does get moderated a bit. I think it is more a question of what India can do to implement reforms. So since the Prime Minister is so fond of slogans and targets, let me give him one target. Let me one reform that will tangibly benefit 100 million Indians across the next 2 or 3 years. Many of the roadblocks to reform come because you do not see people benefiting. No particular constituency sees itself benefiting at scale from it. We came very close to it. I'll give you 2 examples of reforms that could do it, which also tune in with what Neelkanth said and actually with what Soumya said. One of the reforms which has, which ended up just being a slogan was doubling farmers' income. What happened? So if farmers were richer today than they were 8 years ago, then you would not have this constant zero-sum game squabbling happening.
No, but can I push back to say if Narendra Modi was allowed to implement some of the reforms that he tried to and wasn't allowed to in some time, maybe some of those riches would have trickled down?
If you look at, and who didn't allow him? The farmers themselves, they must be mad then. I wouldn't call them mad. I think it was very simple. The doubling of farmers' income report that actually came out was quite ancillary to the reforms that happened. They were good reforms, some of them not so good. But that was not the main point. The second point I would make is, for example, a slum-free India. So anyway, that's one basket of things. You want to think big, and that relates to my second point. Stop talking about popcorn on GST, okay? Really, government has to get out of this trivialization mode of looking at popcorn on GST. No, but
you're making this sweeping point about, say, farm reform, which is so politically contentious. Having burnt his finger the first time, do you seriously think...
I did not say farm reform. I said doubling of farmers' income, his words. There was a policy to double farmers' income. Persist with it and find ways in which you can, if not give a doubling of farmers' income, to give a 60% rise of farmers' income. Farm reform, that kind of phrase works in South Delhi. Doubling of farmers' income gives you 80 million farmers who are winners. The broader point is, it's not just farm reform. If you don't like it, you can do something else. You can try a slum-free India. But get large quantities of Indians to benefit from the economic actions you take. You will get then support for reforms. If the reforms are all going to be about 30, 40 million people benefiting, at the top end of the scale as what we are seeing, you will not get that support. And India is, as far as now, still a democracy, and you're not going to see action happening. Get things to happen to increase prosperity in UP and Bihar. That's one set of things. To do that, The second set of things you've got to do is stop setting targets like communists and stop trivializing policy. Stop talking where the majority of discussion is on the income tax rates, personal income tax rates of the high end. That's important. But it's not like central to the lives of the majority of Indians who don't pay income tax. If you're going to talk about GST on popcorn, and we're going to talk about, second-hand cars and the GST on that, you get an impression that the economy is being trivialized. And that trivialization is something that government really needs to stop. You need to start concentrating on the big picture items of the day, and that is what I'd like to see Mr. Modi and Mrs. Sitaraman and the general stakeholders behind them do. Because politicians respond to incentives. And clearly the incentives are not to respond to mass at-scale increases in prosperity. That's my limited point.
Okay, so we've covered a lot of ground. You heard different points of view, and I'm glad that we were able to cover the ground that we did. I want to thank Samyakanti Ghosh, Ratin Roy and Neelkant Mishra for joining us. The broad consensus seems to have been that 5.4 may have been alarming, but it's not where the economy will stay. There's likely to be a bounce back. The extent may not be the extent that India requires for a massive structural change, but will bounce back to more in the range of 6.5%. I want to thank our guests for joining us. Wish you all a very happy new year.